Hi everyone. What I would like to do is go through a straight line depreciation scenario. And in this particular video, I will be acquiring an asset, fully depreciating that asset with no salvage value. That's really important. And I'm going to dispose of that asset once it's fully depreciated. So in this scenario, I am going to retire a piece of machinery that was purchased on a certain date. It cost $120,000, had a useful life of 10 years, and no salvage value. I'm going to go through all the journal entries that would be made during the life of this asset and then dispose of it. So the first thing I do is when I acquire this piece of machinery, I'm going to debit machinery for $120,000. And I'm going to credit accounts payable for $120,000. The next thing that I have to do is I have to take that purchase price, subtract any salvage value to come up with the value of this asset that will be depreciated over time. Therefore, since we don't have a salvage value, the purchase price and the value that we will depreciate are the same amount of money. So I take that $120,000, I divide by 10, and I get $12,000 per year that will need to be depreciated. So at the end of the first year, since we bought this on January the 1st of a particular year, at the end of that year, I will need to have recognized $12,000 of depreciation expense. So over that period of time, or either once at the end of the year, you would debit depreciation expense for $12,000 and credit accumulated depreciation for that piece of machinery. So you see over on my T accounts that I have a debit to depreciation expense and a credit to accumulated depreciation. Now, the next thing to notice is that every year through 2011, which is the total 10-year period that we're talking about, I will have created that same journal entry in order to depreciate this asset, so that over that 10-year period, when I purchased it originally, it cost $120,000. By the end of its life, it needs to be fully depreciated by that $120,000. So it's important to note that in 2012, for example, this piece of machinery will have no value on the books at all because it has that original purchase price of $120,000 and it has accumulated depreciation recorded for it, and that is $120,000. So they offset. Now, the important thing to remember also is that that $120,000 purchase price remains on the books, and the associated accumulated depreciation stays on the books for as long as you own that asset. So if we owned that piece of machinery for 20, 30, 40, 50 years, that original purchase price and all of that accumulated depreciation would just sit in the books. Therefore, if you were to look at a balance sheet, if you were to look at a detailed balance sheet, oftentimes you will see assets and then there's an accumulated depreciation line. Most of the time when you look at financial statements, you will see a consolidated line item that is called fixed assets or it's called property, plant, and equipment. Either one, they're representing the same thing. But within that, you will have different pieces of machinery or land or buildings. There's all kinds of different things that could be in there. And there's associated accumulated depreciation to those assets as well. And then finally, we decide at the end of 2012 that we are going to dispose of this piece of machinery. So in order to get it off of our books, what we will do is we will debit and clear out that accumulated depreciation. So we will debit accumulated depreciation for $120,000, and we will credit the piece of machinery for $120,000. And that is what gets it off of our books. So if you have any questions about this scenario, please do ask in the comments down below. I will be happy to get back to you if you have any questions about this. And I look forward to seeing you on another video. Thanks.